If you've spent any time learning about investing, you've probably heard the idea that the more money you have, the more risk you can afford to take. In fact, this is the entire premise of shows like Shark Tank. But once we get to retirement, the opposite appears to be true. At least that's what the research tends to show again and again. Because once your portfolio reaches a certain size, you don't actually need the market anymore. In fact, research from firms like Morningstar and other leading retirement researchers show that the wealthier a retiree becomes, the less investment risk they actually need to take and the less risk they do take. Hey guys, what's up? Today, I want to walk you through why this happens, what the data shows, and this just might change your idea of how you should be investing during retirement. There is a certain level of wealth where fear tends to shift. You tend to stop worrying about running out of money, and you worry rather about taking unnecessary risks that could otherwise jeopardize everything you built. And to understand this, let's go over something very simple. In retirement, your entire financial life can be boiled down to one equation: your portfolio relative to your spending. And this is often referred to in retirement research as your funding ratio, simply your portfolio divided by your spending needs. This single concept explains almost everything about how much risk we feel we should be taking, because as that ratio increases, things change. Here's the first piece of data that we need to focus on. Retirees do not spend a fixed percentage of their portfolio. Every bit of retirement research we have tells us that is just not how things happen. In fact, research from David Blanchett and Morningstar shows that around 75% of retirees actually reduce their spending over time. Spending tends to decline by roughly 2% per year in real terms early in retirement through mid-retirement. Now, I tend to talk about this decline in spending a lot because I think it's a very important point to get across, because understanding how spending truly looks in retirement can help us set a realistic target portfolio. Further, and overwhelmingly, among wealthy retirees, they often spend far less than they could. Researchers call this the retirement consumption gap. In plain English, this means retirees, even when they can spend more, often choose not to. What would this look like if we put numbers to it? It means a retiree with a $1 million portfolio might need to withdraw 4 to 5% to support their desired level of spending, but a retiree with a $5 million portfolio may only need to draw 2 to 3% to support their desired level of spending. As wealth increases, required withdrawal rates tend to fall. That's the first domino, and a lot of this makes sense intuitively. The habits it takes to build 1 million, 2 million, 3 million, or even 5 million are generally working hard and having a disciplined lifestyle. And yes, while $5 million is absolutely a significant amount of money, many people who've built this level of wealth are still everyday millionaires. So their lives look fairly normal, and that means that their spending is relatively modest compared to their total portfolio. Now, let's build on that. Morningstar's latest withdrawal rate research suggests that a withdrawal rate around 3.7 to 3.9% is generally considered sustainable for a balanced portfolio over 30 years. But here's the key. That assumes a typical retiree, not someone who has significantly more wealth than they truly need. Because once your withdrawal rate drops into the 2 to 3% range, the probability of running out of money in retirement drops significantly. In fact, for many high-wealth households, the portfolio is no longer just sustainable. It's often well overfunded relative to their lifestyle. Quite simply, the higher your funding ratio, the higher your probability of success. And once you reach these very high funding levels, the risk of failure doesn't just drop dramatically, it collapses to almost zero in many situations. Now, next comes the part that many people may not intuitively understand, because we're kind of trained to think in this idea of more money means more ability to take on risk. For instance, let's say you have $1 million investment portfolio. You live a solidly upper middle class lifestyle. You have a fully paid off home, couple fully paid off cars. All signs point to the idea that you should be able to have a fairly aggressive portfolio. But retirement research shows something very different. More money means less need to take risk. From an academic perspective, research on the optimal portfolio construction shows that when a household's wealth exceeds what's required to sustain retirement, their optimal exposure to risky assets declines. So, essentially, once you've won the game, you simply don't need to keep playing as aggressively. Now let's talk risk capacity versus risk tolerance. The distinction between these two topics is very important. Risk tolerance is how much risk you are comfortable taking. Risk capacity is how much risk you can afford to take without jeopardizing your plan. As wealth increases, we often see that risk tolerance stays the same. But what's interesting is that we'll see that risk capacity tends to change. At lower wealth levels, you need returns. You need growth. You need the market to cooperate. If you're just starting out on your personal financial journey, you need to invest fairly aggressively. You need your money to compound over time in order to reach financial independence. Your ultimate success depends on how the market performs in the long term. And if you're too conservative, you may never be able to retire. At higher wealth levels, you're no longer really dependent on market outcomes. Your plan works even with a modest outcome. Volatility becomes more dangerous and more risky. Let's revisit our household that has $5 million invested. If you capture an 8% rate of return in a year, that's giving you $400,000. Now, it's unlikely that you're going to spend that much. So, what if you're more conservative? What if you capture a 5% real rate of return? That's still going to produce $250,000. If you're spending less than this, your portfolio is still growing, even if you're conservative. Let's take a moment and really walk through this. At its highest level, remember your retirement success really depends on that one concept we mentioned earlier, your funding ratio. This is just your portfolio divided by your spending needs. If we take 3 retirees, one with $1 million, one with $3 million, and one with $5 million, and we look at relatively modest spending levels, here's what you might see. A $1 million portfolio with desired spending of $60,000 requires a 6% withdrawal rate. A $3 million portfolio with $90,000 spending requires a 3% withdrawal rate. A $5 million portfolio with $120,000 spending requires just a 2.4% withdrawal rate. Each of these scenarios creates a very different lived experience. At $1 million, returns are required. A 6% withdrawal rate puts you in a zone where risk of failure is real. You need growth. You need market cooperation. You're exposed to sequence of returns risk, longevity risk, and inflation risk. This typically means a more aggressive, equity-heavy portfolio and a need for flexibility. At $3 million, you enter the balance zone. A 3% withdrawal rate dramatically reduces failure risk. Historically, a balanced portfolio at this level has not run out of money. You still care about growth, but you're no longer dependent on it. The focus begins to shift toward income reliability, tax efficiency, and strategic withdrawals. At $5 million, you're in an overfunded zone. With a 2 to 2.5% withdrawal rate, the risk of running out of money is essentially zero. The portfolio is likely to keep growing even with conservative returns. At this stage, returns are no longer the primary goal. Protection becomes the priority. When wealth exceeds what's required to sustain retirement, optimal exposure to risk declines. The goal shifts from maximizing returns to preserving outcomes. And remember, these are conservative assumptions that don't even include other income sources like Social Security, pensions, or part-time work, which would make the situation even more secure. So the mindset changes. Earlier in life, you need growth. But later, once your portfolio reaches a certain size, you realize it's going to survive regardless, and that changes everything. The biggest risk becomes taking risks you no longer need. If you step back and look at this as a whole, the pattern becomes clear. At $1 million, you need high market participation. At $3 million, you need balance. At $5 million, you may need surprisingly little risk at all. This has nothing to do with personality. It has everything to do with how much you rely on market returns for success. Research consistently shows that wealthier retirees tend to reduce risk. They increase allocations to bonds and cash, build income floors, and focus more on stability than growth. Lower volatility improves income stability and reduces sequence risk, especially early in retirement. So if you don't need higher returns, why take on higher risk? Behaviorally, many retirees withdraw less than 2%, many portfolios continue growing, and many retirees pass away with significant unspent wealth. Even so, they still worry about running out of money, healthcare costs, longevity, and legacy. So they spend less and take less risk, often ending up with more than they started. This creates a different kind of challenge where wealth is never fully utilized. So while more money might mean taking more risk during your working years, in retirement, the opposite is often true. Once you reach a certain level, the focus shifts to protecting what you've built because, in many ways, you've already won. So the real question becomes, how much risk do you actually need to take? And for many retirees with strong portfolios, the answer might be far less than you think. What are your thoughts on risk in association with wealth levels? I post new videos every single week. If you got anything out of this, please give it a like. If you're new here, please consider subscribing. Or if you know someone who might benefit from this, consider sharing. I'll see you soon. Bye. No longer just sustainable. It's often well overfunded. Well, relative, like the rabbit. What was that? The pesky rat. What is that? Looney Tunes. Elmer Fudd. I just spoke like Elmer Fudd. That's like a reference no one is going to get. My son will never understand that reference, and my audience will understand that reference. I'm in good company here. If you've been with me long enough, you know I changed my microphone. The problem is that this microphone has its own battery, and I have to physically turn it on at least once a week. I'll film, and I won't have my mic on, and then I have to refilm everything. I'm not happy about it, but it seems like this mic shows up better on camera. I need a different mic setup, but that involves buying a new camera. And if somebody wants to do the research and tell me what camera, what lighting set, and what microphone I need to buy. I'm not good at selecting audio-visual equipment. I need help with that, so if somebody wants to help me, I would love it.